GM, good morning. Welcome to the Milk Road Show, the daily crypto show where we serve news as hot as your morning toast. I'm your host, Jay Hamilton, and today we're talking about very positive economic and macro data out of the US this week. Here to guide us is Milk Road co-owner and head of research, Kyle Reidhead. Kai, let's start with what happened this week compared to where we were just a few days ago with economic data that came out of the US.
Yeah, so we had a nice episode, I think on Monday or Tuesday with Lark, where he talked all about the chances of recession. Great episode, by the way. Absolutely love that. And things were looking maybe a bit grim in his episode. So we had a bunch of data that came out this week, many of it actually really good in terms of reaching a potential soft landing. We'll start with on Tuesday, we had the PPI, which came out, PPI inflation. This is the cost to produce goods. And that was actually lower than expected. It was 2.2% and expectations were 2.3%. So this is really, really good. Core PPI inflation fell even more. It was 2.4%, below the expectations of 2.7. So this is generally a good sign as CPI tends to follow PPI. Not always, depends where you're on the cycle, but either way, really good. The next day on Wednesday, we had CPI come out. And this one came out at 2.9%, expectations at 3%. So really good to see inflation under 3% for the first time in a while. I'm not sure when the last time we managed to get below 3%, but I think it's been at least over a year, if not longer.
2021, March 2021
was the last time we were below 3. Wow. Okay, so obviously good news there. Then just this morning, actually, as we record, which is Thursday, we had a few other ones that came out, which was jobless claims, which was below expectations once again. So it was 227,000 versus the estimations of 236,000. And then retail sales, which were 1% estimated at 0.4%. So what does this all mean? It means inflation is still coming down. It looks like that trend is going to continue. Well, at the same time, the economy is actually doing quite well. If you remember from Lark's episode the other day, if you haven't watched that, go check it out. The whole concern is, will the economy collapse along with inflation? And if inflation goes down too much, then that's no good because that means we're heading to recession. If unemployment and job claims and all these things are really bad, if people aren't buying things, consumers aren't spending, that is really bad. It means we're going to recession and it's likely we're going to have a big shock in markets. Well, at least this week, and again, this data comes out pretty frequently, so this doesn't mean we're for sure out of the weeds. But what we saw was low inflation, but not too low, right? And then we saw lower job claims, right, which is good. And we saw some pretty decent retail sales, meaning people are still spending, but they're not spending too much. That it means inflation is going to go up higher. So far, we're sort of like threading the needle right now on the economy in the US. And so we got to give some kudos over to our boy, Jerome Powell, for not moving rates, not doing too much, actually just making things just right so far. We'll see what happens. Again, this doesn't mean that this is all the be all end all. We still have a lot more to go here. What we're seeing right now in terms of unemployment is it's still trending up. We haven't had a new unemployment release yet this week. And so that doesn't come for a little bit. And so if you look at the trend of unemployment, it's up, but it's up just a small amount. It's trending upwards. It takes a long time for that to change. No quick, like month over month is just going to all of a sudden change that. It takes a while for that trend to slow down. The key is we don't want unemployment to go up too much. We want it to continue to go up, to be honest. I know that sucks for those who need a job, but we do want it to go up, continue to go up just a little bit more so that Powell in September does lower rates. We just don't want it to go up too much where he has to like lower rates a ton, or again, we have fears of going into recession. So again, we just don't want any big crazy moves. We just want a little bit here, a little bit there. We want the economy to be great, but not that great. And we want inflation to go down, but not too much. And so that's the world we're in right now, which is kind of funny, but it seems to all be working out as we've hoped. So it's a lot of good news at the moment.
One question that we're getting a lot from our listeners and our pro members in our Discord is this concept that we've been talking about for months, which was that we want bad news. And now we're saying, okay, this is good news, but I thought we wanted bad news, Kyle. Can you explain this good news, bad news without saying good news and bad news too many times?
So we wanted bad news because we needed the economy to be not so great so that the Fed would lower rates and give us some liquidity. Okay. So we wanted bad news for a while there. We got our bad news over the last few months. Now we're at a point where the bad news is here. And now we need a little bit of good news. Okay. We flipped. So now you don't want bad news anymore. We want actually good news. We want inflation to go down. We don't want the economy to be so bad. We want things to get better and better and better. And so, but not too much. So at this point, we flipped, and now good news equals good news. And so that's what we're looking for, is just good news moving forward, but not too good. So anyway, I did say good news and bad news too much, as you asked me not to, but it's just the way it goes. So we're in a weird time in markets, but somehow Jerome Powell seems to be threading the needle. I think what happens here is, because of the numbers we've seen, at least this week, probably next month in September, he's going to lower rates. There's speculation is going to be 25 basis points. Is going to be 50 basis points. A lot of people thought it might happen sooner because of what happened with Japan, which, by the way, that's still an issue. And we still don't know what's going on there. So far, the Japanese have kind of stepped back and said, we're not going to keep raising rates. But this morning, there was a bit of a jump in the yen. So things are still a little bit iffy and shaky over there. So we have to keep our eye on that. But our focus is mainly on the US market, of course. But just hopefully Japan can figure their shit out and it doesn't ruin this potential soft landing that Powell is looking for. So I think we'll probably see a 25 basis points drop in the US. Maybe we get 50. We'll see. The percentage isn't that high anymore. But 25 should be fine. And as long as we just continue to do that, I think we're pricing in something like 8 basis points or 8 cuts in the next year or so. And so as long as, again, the data continues to do well, like we're seeing, then I think we're going to see a nice soft landing here, which means probably not jumping into recession. Although, again, we can't rule it out, but likely just things got bad, but not so bad. And so we can lower rates. We can start to pump out liquidity, which is already rising across China and the US. And that means really good things for risk on. We're still not there yet. So we're not in the banana zone, as we call it, as many people are saying, crypto Twitter. But we are getting the sort of signals that might get us there. Again, we still got to wait and see. Nothing's a for sure thing. But things are looking pretty good after this week.
Good to hear that good news is good news again. And if you're confused about bad and good news, join Milk Road Pro and we'll explain what the heck we're talking about to you in great detail. Kai, what I'm hearing through this conversation today is a lot of talk around monetary policy, a lot of talk around the impact that governments are having on markets now. You get a great episode a week ago all about how we are in this current state of monetary policy impacting the markets. Can you connect that one more time for everybody around why Japan and the US and the Fed and all these economic data, even when, CPI comes out and it's just 0.1% different, somebody might say, it's only 0.1%. That's not big a deal. But these little things seem to be making a big impact on the market right now.
Yeah. So remember, it's all about liquidity. And what we need is just the Fed's ability and central banks around the world to just print money, which they're going to basically do anyway. The key is we want them to be able to do that in a low inflationary environment. And that seems to be what's happening here. So the whole idea is we need to invest when the dollar is going down or when fiat currencies are being debased. I talked about this a lot last week. And that looks to be happening. The US dollar appears to be weakening, which is coming because when you lower rates, when you increase liquidity, the dollar has no choice but to get weaker. Every time we have seen the dollar get weaker, we go into bull markets. And I believe that is where we're at right now. The dollar peaked back in, I think it was 2022. I don't know if we have a chart of the Dixie right now, but if we did, you'll see that it peaked back then. And that's when we had our big move in 2023. Now it's sort of been just range bound for the last little while. And it looks like it might start to drop. And that, again, that's just the market sniffing out that, hey, rates are about to go lower. When rates go lower, obviously the dollar gets a bit weaker. And so that's a signal telling us, hey, bull market coming. And so, again, it's all points to the same thing, which is liquidity. And we just need the ability, or the governments need the okay to print. And right now, as we have a worse or a weakened economy, that means that they can start to print money. And as long as inflation is not high or too high, then they're good to go. And so, again, we're sort of reaching that moment where, same as we always have right now, it's been these 4-year cycles since really 2008. But I actually wonder if we can even get into a recession these days, because, again, as you said, we're so controlled by monetary policy that as things get weaker, we just lower rates and then we print money. We've been printing a bunch of money this year already. And so, maybe we should have gone into recession. It's just the Fed doesn't let us, right? And global banks around the world don't really let us go into recession. We haven't had a recession since basically 2008. Now we had one during COVID, but that was obviously there's an asterisk to that one. And it was like a couple day long recession. It was just based off certain indicators, but they printed our way out of it. And so again, what are we seeing here? As the economy weakens, instead of letting us get into recession and let things figure it out, we just manipulate, right? We lower rates and we print money. And so I wonder, at least at this point, when we're in so much monetary policy, as I talked about last week, I wonder if we can even get into a real recession. And I don't know that we can. And so all eyes on liquidity, all eyes on rates. And I think things look good right now.
And more closely tied between the liquidity and the impact on markets when we're in these heavy monetary cycles as we are in right now. Now, one question that we're seeing a lot as well, which quite honestly, I'm also confused about this, so I hope you can explain this for us, Kai, is on-chain activity appears to be hitting all-time highs, but yet price action of crypto tokens is not. It's what's going on? Why is there not this connection? And maybe you can, I've got the chart of active addresses from A16Z. So maybe you can give us an idea of what's going on for our listeners here.
Yeah. So right now, markets don't care about what's happening in tech, right? They only care about what's happening in macro. They only care about liquidity. Okay. And once macro tells us, hey, not a recession, time to go into bull market, dollar weakening, blah, blah, all the things that we've been saying, then this stuff matters. And so if you look, the chart you have up right now is a great chart, by the way. It's super, super bullish crypto, which is basically month over month, we are reaching all-time highs in active addresses. July was just shown here. And we just passed June's all-time highs. We're at 54 million active addresses online. This is across, or on chain. This is across all blockchains. And so the best analogy for this is, if you think of on-chain activity, it's like pouring a bunch of gasoline on top of a log, right? So obviously that should have a big impact on a fire, except there is no fire. And so it actually doesn't matter. Now, once the flame is lit, the match has struck, which is macro, all of a sudden that gasoline that's on that log, it really freaking matters. And so if you think about this in reality, what's happening here? When macro goes risk on, what it means is, okay, rates are down, liquidity's up. It means there's a lot of money, because money is now cheap, to go somewhere, to go into some sort of investment, right? And now where do those investments go is the question when we go risk on. Well, it's going to go where there is adoption, at least in terms of tech, right? It goes in where the money could potentially grow the most. And so what institutions look for, what investors look for, is where is the adoption? Where is the growth? Where is the innovation? And right now, it is definitely in crypto, because you're seeing the on-chain activity go up and up and up and up and up. And so whenever we get that signal of risk on, the banana zone, that means a lot of that money is probably going to come to crypto because it has adoption, it has growth, it has new users coming in all the time. Whereas if on-chain activity wasn't good and we got this risk on environment, a lot of money still wouldn't come into crypto, right? It might go into AI, or it might go into robotics, or it might go into whatever else. But because we are seeing this buildup of on-chain activity, we are seeing the fundamental numbers of crypto get better and better and better. Once macro turns the way we need it to, and that match is struck and the flame is there, it's going to just go absolutely nuts, which is the same thing that happened back in 2020. 2020, we had DeFi summer. Everyone was using DeFi for the first time. We finally had all this activity on chain after like years of basically everyone thinking crypto was dead, but things still didn't go up. We had to wait. And all of a sudden, after COVID, we kind of got out of this recession and they started printing a ton of money and rates went to zero. But what happened? There was so much money in the system. Everyone said, where should I put it? And it was like, well, crypto has a ton of adoption right now. I'll put it in there. And then we blew up. And at the end of 2020 and 2021, we just went in this crazy bull market. It looks like we have the exact same setup here. We've been on pause in terms of prices since basically March, right? But that's not because crypto isn't doing well. If you look at stablecoin activity, you look at on-chain activity, you look at what's happening with DePIN and Helium and all the things, adoption is there and it's getting more and more and more. It's just we haven't had that flame yet from macro. And so another analogy you can think of right now is like, the more that on-chain activity picks up and the more we get this adoption and growth in crypto without macro there, it's like holding a balloon underwater and just like continuing to push it there. And the moment that you remove your arms, what's that balloon going to do? It just goes shoom, and it shoots up out of the water and flies in the air. That's what's happening right now with crypto prices. Okay. And so it's all coming into fruition. All the things we want, we just need macro to get figured out. And It looks like it will, at least from the data we've seen this week. Now, of course, it doesn't mean it will for sure. Nothing is a certainty, but our investments, our portfolio is set up in the with the idea that it is going to go our way. And so we'll see if Jerome Powell can thread the needle and we can get this soft landing. But the backdrop of what's going on in crypto is set up perfectly. And I didn't even mention the ETF stuff, right? Like you've got Bitcoin and ETH ETFs. You've got tens of thousands of advisors all around the US, which are going out to teach others all about Bitcoin and ETH because they need to make sure these ETFs do well. What do you think is going to happen when the macro environment turns and we go risk on? There's just the perfect setup here. Anyway, looks good in my end.
So question, and the last question to wrap up here is, I think, and I know you don't have a crystal ball, but what are the things that you are looking for that will indicate that we are getting the macro setup that we need, that we are entering that risk on banana zone time? And do you have any idea, is it the next rate cut coming in September? Like, obviously that's a big date. What are the other things that our listeners should be watching out for in the coming months?
Honestly, the key is just keep doing what we're doing right now. Inflation below 3% is key. That's the big thing, because that sets us up to be able to continuously lower rates. I don't think we're going to have some big like 1% rate cut or whatever. I think it's just going to be 25 bips in September, maybe another 25 in October. At least this is what I hope. And we just slowly grind down in terms of rates. If that happens, perfect. If they have to do some like immediate huge cut, that's going to be problematic. We want it to just be gradual. And so I think let's see rate cut in September and then again in October, ideally, or November, whatever. Let's see inflation remain below 3%. Honestly, unemployment can continue to rise. I'm not mad about that, but rise slowly. Nothing too crazy there. And then I think we're just going to see liquidity go up and up and up over the next few months. We're already starting to see it. We've just reached all-time highs last month. And so a few weeks ago, I think it was. And so all the things are set up. And I don't know why people are so bearish. It's because there's just some weird metrics in terms of like all the different indicators that show recession. A lot of it is confusion around unemployment. I just think we live in a very different world post-COVID than we did before. And so some of the old indicators just don't really work so much anymore. Like, Jay, if you think about our company, for example, we hire close to 30 people. Not one of them are an employee, right? Mm-hmm. Actually, we have 2 employees in our company, and they are both in the US, but neither of them are American, right? Everyone else is a contractor, a freelancer, right? And they're full-time, but they're contracted because they're remote. They live in different countries around the world, et cetera. And a lot of companies are going this route. And so a lot of people are going freelance. A lot of people are starting their own companies because of the internet. And a lot of people work as contractors because they're just in different countries. And so like the unemployment numbers and the jobless numbers and all this stuff is it's very different than it used to. And so I think a lot of the data is kind of mixed. And so you have these weird signals telling us that we're in a recession or things are worse than they actually are. And I think there's just, and plus immigration has changed so much now. And so it's a weird world out there. And I just don't know that a lot of the old indicators still matter. There's still a bunch that do, of course. I just think it's very confusing now. And I don't know, when I look at where the economy's at, like I live across from the mall right now, Jay, and I look out every day and the mall parking lot is freaking packed every single day. And I took a picture and I posted on Twitter yesterday. It was literally just like every single parking lot was full on a Tuesday afternoon this week. And I was like, why? What is going on? You know? But I just can't see that we're in that bad of a recession. And to be honest, in Canada, the rates have affected us way more than in the US because most of Canadians have variable mortgage rates, whereas in the US, everyone locked in at like 0% rate. So like the interest rates aren't that big of a deal in terms of like consumer spending in the US. So for me, I just think we just need to see things continue to go as they are. It looks pretty good. The main thing I'm watching for and I'm scared of is Japan. If that continues to break, then it's going to be hard for the US to lower rates. If Japan has to and is forced to raise rates, that's going to make that carry trade a really bigger deal than it is. That is a big deal in the sense that there's trillions of dollars in it. But like, you know, the Japan moving up to 25 basis points isn't that big of a deal. It becomes a big of a deal if they have to keep raising and the US has to keep lowering. Because then there's like even the non-risky stuff in that carry trade needs to get unwound, which right now it doesn't. So that's like the only thing that's really on my mind that worries me. But I don't know. I kind of think we'll figure out a way through that. And probably it just means we're going to have to print money to fix it anyway. So like I always go back to the same thing, which is just like it's all about liquidity. And if we just look at the liquidity charts, They're up, and I see no reason why they won't continue to go up. So it's hard to be bearish at this point. I don't know. Does that answer the question?
Yeah, completely. I also like that you finish with it's hard to be bearish, because we certainly have had a few weeks here of a bear vibe and a feeling of fear in the space, which is strong. Fear is a very strong emotion for everybody.
And I don't think we're out of that yet. So like people still need to be patient. It's funny. We put out a pro report last week. So Saturday, 5 days ago, saying like, hey, here's what happened with the Japan carry trade. Here's why we had that big shock last week. And, we think it's all good. And then it's Thursday today as we recorded. We had so many people in our pro Discord going, guys, what's happening? Things look so bad. Lark's, episode on Tuesday or whatever, like everything's scary. And I was like, guys, like, can we get an update? And I was like, I just gave you one 5 days ago. Nothing's changed. What do you mean? If anything, everything looks much better. So we got to be patient and just let this all unfold. I think the rate decision for the US isn't until like September 18th, so like a month away still. So like this is probably going to be a little bit choppy and painful for the next few weeks at least. And then there's still the election to get through. So maybe we have to wait until after November 6th or whenever the election is until we go full bull. I don't know. But just we got to be patient right now and just let things unfold. These things don't happen in a day. They happen over weeks to months and much longer. And as I've said every time on this episode, we are invested for the cycle, which is 12 to 16 months, potentially even longer. We are not invested for the next couple of days to weeks. So again, just don't worry too much about the next couple of weeks. There's like a month left in summer. Go enjoy that.
Wait, be patient? No,
be patient.
That's not, I can't do that. I
did an episode yesterday with Zeneca all about psychology. And I think everyone needs to go listen to that and try to manage psychology, because summers are tough, man. These summer lulls are actually really, really tough. It happens a lot. Like the big money leaves, they go to the Hamptons and they take the summer off. And so like nothing happens during summers. There's been a lot of volatility. So it feels like lots has happened. But when you look back, we're just where we were back in March, right? We're at the same levels we were back in March, except in March, everyone was like, holy shit, so bullish. This is the best. Bitcoin at 60K or whatever. And now we're at 60K and everyone's like, oh my God, the world's ending. It's like, dude, that was 4 months ago or maybe 5. I'm not sure what it was now, but like, it's really not that big of a deal. But when it's boring in the boring zone, right? It's tough to manage the psychology.
Yeah, it's so true. I want to know, you listeners, I want to celebrate anybody who has not made moves recently. So post in the comments.
Other than buy. If you bought, that's fine.
Yeah. Let us know if you're sitting on your hands and I'm going to give you a high five, or let us know if you're just doing your same old boring DCA. Like, rock on, good for you, because everybody else, you're the ones that need to go listen to the psychology episode from yesterday, because you're probably the ones that's struggling. Kai, thanks so much for joining us again today. If you liked today's show, would really appreciate if you guys give us a like and subscribe to the channel, because as Kyle said, 5 days ago, things were different. And 5 days from now, things will be different again. So we want to make sure that you guys stay up to date. And that's why we put out episodes every single day, to keep you in the calm zen, to have that calmness, to be able to make smart, informed investment decisions. Remember, none of this is financial advice. Investing in crypto or any asset is risky, and you should only invest what you can afford to lose. Thanks so much for listening in, everybody. Have a wicked awesome day.